Comparative financial statements are an essential tool for analyzing the financial performance and position of a business over multiple periods. They enable stakeholders to observe trends, patterns, and anomalies in a company's financial data by presenting figures from two or more accounting periods side by side. This method of presentation does not merely display raw numbers, but also facilitates deeper insights by highlighting changes in revenues, expenses, assets, liabilities, and equity. Through comparative financial statements, management, investors, creditors, and other interested parties can make informed decisions regarding the future course of action, potential investments, creditworthiness, and overall business strategy. At its core, a comparative financial statement is a set of financial reports, primarily the balance sheet and income statement, presented in a format that allows for direct comparison between different periods. For example, a comparative balance sheet will show the figures for assets, liabilities, and equity for 2 consecutive years, with columns indicating the absolute change and percentage change from one year to the next. Similarly, a comparative income statement will present revenues, cost of goods sold, gross profit, operating expenses, and net income for multiple periods, again with columns for both absolute and percentage changes. This side-by-side comparison helps identify not only the direction of change, but also the magnitude, which is crucial for meaningful analysis. The primary objective of comparative financial statements is to provide a clear and concise picture of a company's financial evolution. By examining the changes in financial statement items over time, users can discern whether the company is growing, stagnating, or declining. For instance, an increase in sales revenue accompanied by a disproportionate increase in cost of goods sold may indicate declining profitability. Conversely, a steady growth in retained earnings and equity might signal sound financial management and reinvestment of profits. Comparative analysis thus serves as an early warning system, alerting management to potential problems or highlighting successful strategies that should be continued or expanded. One of the significant advantages of using comparative financial statements is their ability to simplify complex financial data, making it accessible and understandable even for non-experts. Raw financial statements can be overwhelming, especially for those without an accounting background. However, when figures are presented comparatively, it becomes much easier to pinpoint areas of concern or opportunity. For example, if accounts receivable have increased significantly from one year to the next, this could indicate lax credit policies or issues with collection. Similarly, a sharp rise in inventory levels might suggest overproduction or declining sales. By drawing attention to such changes, comparative statements enable timely and effective management intervention. Comparative financial statements are invaluable for internal management purposes. Managers rely on these statements to evaluate the effectiveness of their strategies and operations. For instance, after implementing a cost-cutting initiative, management can use comparative income statements to assess whether expenses have indeed decreased as intended. Any deviation from expected outcomes can prompt further investigation and corrective action. Moreover, comparative analysis aids in budgeting and forecasting. By understanding past trends, management can make more accurate projections for future periods, thereby facilitating better resource allocation and strategic planning. For external stakeholders, such as investors and creditors, comparative financial statements provide a basis for evaluating the company's financial health and stability. Investors are particularly interested in trends related to profitability, return on equity, and earnings per share, as these metrics influence the value of their investments. Creditors, on the other hand, focus on liquidity and solvency ratios derived from comparative balance sheets to assess the company's ability to meet its short-term and long-term obligations. A consistent improvement in these ratios over time enhances the company's creditworthiness and may result in more favorable borrowing terms. The process of preparing comparative financial statements involves several steps. First, the financial statements for the periods under consideration are extracted from the company's accounting records. Next, these statements are arranged in a columnar format, with each period's figures appearing in adjacent columns. Additional columns are then added to show the absolute change, the difference between the figures for the two periods, and the percentage change, the absolute change divided by the figure for the base period, multiplied by 100. This format ensures that users can immediately see not only what has changed, but also by how much and in what proportion. To illustrate, consider a comparative income statement showing sales revenue of $1,000 in year 1 and $200,000 in year 2. The absolute change is $200,000 while the percentage change is 20%. If the cost of goods sold increases from $600,000 to $800,000 over the same period, the absolute change is $200,000 and the percentage change is 33.33%. While both sales and costs have increased by the same amount, the higher percentage increase in costs suggests that profitability may be under pressure. Such insights are only possible through the comparative format, underscoring its analytical value. Comparative financial statements are also instrumental in conducting ratio analysis. Ratios such as gross profit margin, net profit margin, current ratio, quick ratio, debt-to-equity ratio, and return on assets can be calculated for each period and then compared to detect trends. For example, a declining current ratio over several periods may signal deteriorating liquidity, while an increasing debt-to-equity ratio could indicate rising financial risk. By providing the necessary data in a structured manner, comparative statements make it easier to compute and interpret these ratios, thereby enhancing the quality of financial analysis. Another important application of comparative financial statements is benchmarking. Companies can compare their financial performance not only against their own past results, but also against industry standards or key competitors. This external comparison highlights areas where the company is outperforming or lagging behind the market, enabling management to adopt best practices or address weaknesses. For example, if a company's gross profit margin is consistently lower than the industry average, it may need to review its pricing strategies, cost structure, or supply chain management. Despite their numerous advantages, comparative financial statements are not without limitations. One significant limitation is the impact of inflation and changes in accounting policies. If the figures for different periods are not adjusted for inflation, the comparisons may be misleading. Similarly, if the company changes its accounting methods, such as switching from FIFO to LIFO inventory valuation, the figures for different periods may not be strictly comparable. It is therefore essential for users to be aware of such changes and make appropriate adjustments or interpretations. Moreover, comparative financial statements may not capture qualitative factors that affect a company's performance. For instance, changes in management, shifts in market demand, regulatory developments, or technological advancements may have a significant impact on financial results, but these are not reflected in the numbers alone. Users should therefore supplement their analysis of comparative statements with qualitative information to obtain a comprehensive understanding of the company's situation. Another potential pitfall is the risk of focusing too narrowly on percentage changes without considering the underlying context. For example, a small absolute change in a low-value item may result in a large percentage change, which could be misleading if taken out of context. Conversely, a significant absolute change in a high-value item may appear less dramatic in percentage terms. It is therefore important to interpret the figures within the broader context of the company's operations and industry environment. Comparative financial statements can be prepared for different timeframes, depending on the needs of the users. While annual comparisons are most common, companies may also prepare quarterly or monthly comparative statements for more frequent monitoring. In rapidly changing industries or during periods of economic uncertainty, more frequent comparisons can provide early warning of emerging issues or opportunities. Conversely, in stable industries, annual comparisons may suffice for most purposes. In addition to internal and external users, comparative financial statements are also valuable for regulatory authorities, tax officials, and auditors. Regulators may use comparative statements to monitor compliance with financial reporting standards and detect signs of financial distress or fraud. Tax authorities may analyze comparative income statements to identify unusual fluctuations in income or expenses that warrant further investigation. Auditors, meanwhile, rely on comparative analysis as part of their risk assessment and substantive testing procedures. Technological advancements have greatly facilitated the preparation and analysis of comparative financial statements. Modern accounting software can generate comparative reports automatically, saving time and reducing the risk of errors. These systems can also incorporate graphical presentations, such as trend lines and bar charts, which further enhance the clarity and impact of the analysis. As a result, even small businesses with limited resources can benefit from the insights provided by comparative financial statements. The adoption of international financial reporting standards, IFRS, and other harmonized accounting frameworks has further enhanced the comparability of financial statements across companies and countries. Standardized reporting formats ensure that similar transactions are recorded and presented in a consistent manner, making it easier to compare financial performance across different entities. This is particularly important for multinational corporations, investors, and analysts who operate in a global context. Comparative financial statements also play a crucial role in mergers and acquisitions. Potential acquirers use these statements to assess the historical performance and financial position of target companies, identify synergies, and estimate future cash flows. By comparing the pre- and post-acquisition financial statements, management can evaluate the success of the transaction and the realization of anticipated benefits. From an academic perspective, comparative financial statements are a fundamental topic in accounting and finance education. Students learn how to prepare, interpret, and analyze these statements as part of their training. Case studies often involve the use of comparative statements to solve real-world business problems, reinforcing the practical relevance of this analytical tool. In practice, the effectiveness of comparative financial statements depends on the reliability and accuracy of the underlying accounting data. Errors, omissions, or deliberate misstatements can distort the analysis and lead to faulty conclusions. It is therefore essential for companies to maintain robust internal controls and adhere to sound accounting principles in the preparation of their financial statements. Ethical considerations are also relevant in the context of comparative financial statements. Management may be tempted to manipulate figures to present a more favorable picture of the company's performance, especially when bonuses, stock prices, or lending terms are at stake. Stakeholders must remain vigilant and scrutinize the statements for signs of creative accounting or window dressing, such as shifting expenses between periods or inflating revenues near the end of a reporting period. In summary, comparative financial statements are a powerful instrument for financial analysis, decision-making, and communication. By presenting data from multiple periods in a structured and accessible format, they enable users to detect trends, evaluate performance, and identify areas for improvement. Their versatility makes them indispensable for a wide range of users, from internal management to external investors, creditors, regulators, and auditors. While they have certain limitations, such as sensitivity to inflation, accounting policy changes, and lack of qualitative context, these can be mitigated through careful interpretation and supplementary analysis. The continued evolution of accounting standards, technology, and analytical techniques will further enhance the utility of comparative financial statements in the years to come. As businesses operate in increasingly complex and dynamic environments, the need for clear, reliable, and actionable financial information will only grow. Comparative financial statements, with their unique ability to distill vast amounts of data into meaningful insights, will remain at the heart of effective financial management and strategic decision-making. Ultimately, the value of comparative financial statements lies not just in the numbers themselves, but in what those numbers reveal about a company's journey, its successes, challenges, and prospects for the future. Whether used to justify a major investment, secure a loan, assess the impact of a new strategy, or simply monitor ongoing performance, these statements provide a vital link between past experience and future potential. As such, they represent not only a record of what has been, but a guide to what might yet be achieved.